The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
And global markets start the week a bit on edge. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. Here's where we stand. You almost didn't make it, by the way. Almost. I did have to run to set, but I'm here now, and I'm here to tell you that the S&P 500, it's kind of uninspired. It's higher by about 0.2%. We are coming off a weekly gain, which isn't something you usually see in September, so that's good news. You can see that big tech actually is having a pretty good day. The Nasdaq 100 higher by about 0.5% or so. I wanted to highlight the 10-year Treasury yield because here's a little bit of a how low can you go situation. You can see that we're knocking on the door of 4%. Yields down about 3 basis points today. We'll see if we can crack it. Meanwhile, I did throw up Euro USD here, that currency pair. We're keeping an eye on what's going on in France. The government in turmoil, the French prime minister losing that confidence motion. We're going to get into all of that. But actually, the euro a little bit stronger against the dollar today. Yeah, the price action today a little ho-hum, but as you can see, that could change in a big way, particularly by some of the macro events that are on tap coming up, including here in the U.S., a broad-based read on the economy, data on small business sentiment tomorrow, wholesale and consumer inflation midweek, and that's bookended by the University of Michigan's consumer sentiment numbers on Friday. And while the FOMC is in a quiet period, its European counterparts, they're set for a rate decision in the midweek as well. In fact, there's a lot more drama overseas right now than in the U.S. Don't forget, overnight, we had Japan's prime minister agreeing to step down. Over in Indonesia, they've been hobbled by protests over economic conditions. The Argentina dollar bonds plunging the most in 3 years. That's after a provincial election is now threatening to undermine President Javier Milei's national economic agenda. And just 2 hours ago, the debt crisis in France officially became a political crisis for Europe. The widely expected collapse of the government of Prime Minister Francois Bayrou. Now, that leaves most of the upside price action today for U.S. equities and beyond confined to technology, which acts as both a growth play and a defensive one to boot. And that could be beneficial for a spate of IPOs anticipated to price this week, including digital payments firm Klarna, crypto exchange Gemini, and data center play, which I just learned about last week, Legence, yeah, a lot to look forward to this week when it comes to economic data, when it comes to the IPO market. But I wanted to just check in on where we stand when it comes to tech. Of course, so goes tech, so goes the market. And you can see that there's an interesting divergence brewing right now between communication services in orange and then the proper tech sector. Now, we often loop in these two groups, but in communication services, you have the likes of Netflix, you have the likes of Meta, and you can see that it's opened up a bit of a gap when it comes to tech. Tech's still up mightily for the year, but communication services pulling away a little bit. Romaine, it's going to be interesting to see how these two lines come back together, whether tech can catch up or whether you're going to see a bit of a catch down when it comes to communication services. Well, let's pose that question to our first guest as we kick you off to the close here on Monday afternoon. Saira Malik is head of equities and fixed income and the chief investment officer over at Nuveen. Saira, great to see you here. Good to see you. Let's start with the tech trade because it has been a fairly reliable trade for the last couple of years. And I wonder whether when you look at valuations there, you look at some of the expectations for Fed rate cuts, is there some sense here that there is a little bit more life to that, not necessarily just because of the euphoria?
The tech trade likely has more legs because investors are going to stay on edge this month for 3 reasons. Number 1, September seasonality. Number 2, Fed rate cuts that are coming. And number 3, inflation data. So let's first start. As we know, September historically tends to be the worst month for equities. Second is the Fed. The markets are expecting a 25 basis point rate cut. At this point, that could be a disappointment for the markets. And the question is, are we going to get 50? And then finally, I think inflation data, CPI and PPI, is going to be a bit of a hurdle this week. So the good news is we're seeing 10-year yields start to moderate. That's good for tech stocks. Rate cuts are good for tech stocks. And that's why I would say don't bet against the U.S. I think tech continues to lead this market. I do want to go back to what you just said there about the rate cuts. You said it could be a disappointment if the Fed only gives 25, because it seemed like a few weeks ago nobody was anticipating 50, and there were a lot of people questioning whether Jay Powell would even move 25 at that September meeting. So your anticipation is we do get 25 basis points, but maybe not necessarily the 50, and the market reaction would be negative potentially? I think 25 basis points is a lock, and we may get a bit of a sell on the news event because markets expect it. So what could be the upside surprise? Could be 50. So when did 50 come to the table? Well, first of all, July jobs when they missed numbers pretty significantly. I think that was the first time we saw the negative revisions for the prior 2 months. That's when 50 came up. And then, of course, we saw another big miss to August jobs. And I think that's what's bringing the idea of 50. But it's not so much about, is it 25 or 50 in September? Do we get 2 to 3 rate cuts before the end of the year? Likely we get 2. I think we may also get 3 rate cuts before the year's over. That could be generally positive for the markets. But we'll see what happens with this September rate cut if it's only 25.
Well, I was just having this conversation with one of our economics editors, and we were having this conversation on air last week that this all feels very eerily similar to where we were exactly a year ago. We got a series of weak payrolls prints, and then we saw the Fed actually go ahead with that 50 basis point cut that we're debating now in September 2025. Are you able to extrapolate anything from what happened last year, especially what we saw with the reaction when it comes to the long end of the yield curve, as to what could happen this time around?
The jobs market is the setup for the 50 basis point rate cut, just like it was in September 2024. But what's different this time, of course, is inflation. We're still not going to see CPI and PPI at the Fed's target. It should be up. Those two numbers still up about 2.5% to 3% year over year. So that's another issue. The economy does remain strong. Now, last year, of course, what we got was the 50 basis point rate cut, and then the Fed basically slowed down and hit the pause button. I think the question is this year is about what is the series or pace of rate cuts we get beyond this September. I think that will be what either drives the markets higher or disappoints investors.
And I just want to point out, too, on that point as well, we had a headline just before the show started that Stephen Myron's nomination, they are planning to vote on that on Wednesday. So potentially he could actually be part of that meeting on September 16th, 17th.
Yeah, and that's one thing that's very different from this time last year is now you have a lot of political interference when it comes to the Federal Reserve and the risk of more to come. But Saira, it's interesting. It feels like the focus in the last few weeks, of course, has been on the economy and what the response is going to be from the Federal Reserve. It feels like it's been a minute since we were trading every single trade headline. And I wonder if that's a potential unappreciated risk here, that we'll get a surprising headline when it comes to tariffs, when it comes to these geopolitical negotiations, and we'll see that sharp reaction once again in markets.
Well, tariff creep is definitely still an issue. I think we're just at the tip of the iceberg of the impact of tariffs on inflation. Well, the data this week, what I'm watching for is, are we going to see a continued pickup in services inflation? What we'd expected was, as tariffs kick in, goods inflation should be impacted. What's been surprising is you've actually seen services inflation continue to heat up. That could be an issue if we finally see that impact of tariffs on goods. Companies we like to watch to get an idea of that is Walmart. I think that's a broad-based view on what's going on with tariffs. We haven't seen a lot of it with back to school, but watch the holiday season. I think that's where you may finally start to see the impact of tariffs on goods.
Where does that leave sort of other sectors that are maybe exposed to both sides of that, both the goods and the services side? Restaurants, for example, at least earlier this year, kind of fell out of favor with a lot of investors concerned about some of those issues, as well as just the broader health of the consumer.
Well, consumer in general has been bifurcated. The high-end consumer is continuing to spend. It's the lower-end consumer who's really struggling. When it comes to tariffs, who's going to eat the cost? Is it going to be consumers or the producers? We think that consumers will eat the majority of tariff input costs, about 75, 80%. Another reason you haven't seen that completely yet is because companies knew tariffs were coming, so they were pre-buying. So a lot of what's still being sold is inventory that they pre-bought before tariffs. That's going to run through, and that's when you'll start to see the impact of tariffs on inflation.
Saira, always great to have you. Great conversation. Saira Malik, Head of Equities and Fixed Income and Chief Investment Officer at Nuveen, kicking us off to the close here on this Monday afternoon with a focus on the economy and a focus on the economists who are expecting major revisions in U.S. labor market data tomorrow. We're going to have a conversation about the state of the job market from the local level. We're going to talk with Andrew Kimball, the CEO of the New York City Economic Development Corporation.
And from the Bureau of Labor Statistics to the FDA, we'll discuss the future of the agency with Dr. Marty Makary. He is the commissioner for the Food and Drug Administration.
We're also going to talk about the future of Apple, what to expect from the iPhone announcement scheduled for tomorrow. Tony Wang over at T. Rowe Price will be joining us in just a bit. Stick with us. This is The Close on Bloomberg.
Well, French Prime Minister François Bayrou has just lost a confidence motion in Parliament, with 194 lawmakers voting in support and 364 voting against. President Emmanuel Macron will name a new premier in the coming days, and they will still have to find a way to pass the budget. Here now with more context, we go to Bloomberg's Oliver Krook. So Oliver, let's start with who could possibly fill this seat right now. Of course, this will be, I believe, the third change of government in just over a year in France.
Yeah, so this will be today is officially the fourth government to fall or sort of be dissolved in the last 2 years' time. And that really speaks to some of the political fragmentation that we have in France, which has basically paralyzed the country over the last year after Emmanuel Macron called those surprise snap elections last summer and basically a catastrophic political miscalculation, which left him completely and weakened in this parliament just behind these doors where they voted once again no confidence for another government. And one of the last sort of pronouncements that François Bayrou would make as Prime Minister of France, he was saying, listen, today you have the power to topple this government. What you do not have the power to do is to ignore reality. And for the French, that is a reality of 51 years now in a row without a balanced budget, a debt to GDP ratio of about 115%. That is the third worst in all of Europe. A deficit to GDP ratio at about -6%, which is about twice as much as the EU average. And that is the reality that is going to be faced whoever is prime minister next at a moment when you have basically this parliament broken up into three equal parts with the center coalition, the far right led by Marine Le Pen, and then the left, which is also a sort of splintered coalition. This just comes to tell you basically the story, not just in France, but this is a fragmented story of politics all across Europe. It's what brought down the German government at the end of last year. We have problems in the Netherlands. You have problems in the UK. Spain can't pass a budget. And at a moment for the European Union that is really grappling with competitiveness against China, a much more hostile United States. And by the way, everybody is now committed to spend 5% of GDP on defense. This is just another sort of example of French and also European political paralysis in a time when they really need to get their act together.
Is there a sense, Oliver, whatever the new government looks like, they're going to have to revisit this debt issue? Are we talking about higher taxation? Is there some sort of template on the table right now that no matter who that PM is, that might end up being the end result?
Yeah, this is going back basically to the drawing board. What François Bayrou tried to do is a sort of more centrist approach, which basically, really heavily relied on cutting the state spending, which is, of course, the bulk of the problem here. There is also some provisions there in tax hiking. You'd like to see, the French left would like to see basically wealth taxes. This is something that François Bayrou said is a fantasy if you think that this is going to bring things into the fore. But the reality of the situation is that basically Emmanuel Macron has tried two prime ministers from the center and the center right. He may now have to go tack to the center left and potentially even further left. That is not going to be welcome news for business across France. Once again, a nation that has already got extremely high taxation and is grappling eternally with its own competitiveness that is being brought once again into the fore.
Oliver, just quickly, what is the message to investors here? I think it's notable that there seems to be little investor reaction in the markets. We were showing Euro USD earlier. It seems like the euro a little bit stronger on the day. We know that French equities also didn't have too bad of a day here, even with all of this uncertainty.
Yeah, well, we should say that this is something that has been effectively priced in ever since the Prime Minister called the no confidence vote. The assumption is that he was going to lose. But I think the problem with the French crisis that you have here, it's the sort of old adage about going broke, slowly at first and then suddenly. When do you get a sort of fiscal crisis? It comes really down to sentiment. What you're going to have at the end of this week is Fitch is going to review France's credit rating. That is likely to be diminished. But again, this comes to the sort of heart of the problem here in France, which has just been spending a huge amount, especially in the wake of COVID, and now has all these military obligations. This is something that is not going away for investors, as placid as they might be for the time being. As long as you sort of limp forward into the future and you have no resolution to this, this is going to be a major problem. And again, just to stress this is not just a problem for France. This is a problem for Brussels and the European Union. You think about the main countries in the European Union that are the pillars that support the EU when it's dealings with Trump, when it's dealings with China. France is the second biggest economy, and that second pillar within Europe just collapsed once again today.
Oliver Krook on the ground there in Paris. And I really was kind of interesting, Katie, when he kind of mentioned the last part, how this really being a bigger issue for Brussels. The idea that what's going on in France is also sort of ailing Germany when you talk about the debt issues. And of course, we don't even really mention Greece and some of the other Italy and some of the other countries that have already gone through this to some degree or another. But it actually brings up an interesting development that also happened over the weekend in Argentina.
Yeah.
A new president there who had been trying to get the economic ship right with the Javier Milei in Argentina. They had a big provincial election in Buenos Aires, basically their capital and really the most important sort of segment of their economy. And it went for the opposition party. And this is a big issue because it seems like potentially some of his economic agenda could be undermined. And we saw some big moves in Argentina assets over the last few hours.
Big day in Argentina. Totally different reaction than we're seeing in France right now. I thought it was interesting, too, to see how the sell side was reacting to this. Bloomberg News points out that Morgan Stanley actually had to close a buy recommendation on Argentinian assets. That was only started last week. And I think that really speaks to what a surprise this was.
Absolutely. It was a big surprise. You saw that in the dollar bonds having their worst day in about 3 years. And when you take a look at dollar peso right now, the biggest weakening that we've seen in the peso relative to the dollar since at least the early 90s, which says a lot given how much that peso has gone through. All right, when we come back, we're going to turn our attention back to U.S. markets and back to what's been going on in the world of crypto, including the recent debut of Bullish to public markets. And now the analysts have come out. We're going to talk to one of the analysts picking up coverage of that stock today and get his thoughts here on where it may go next. That's coming up next here on The Close on Bloomberg. Time now for our top calls, the big movers on the back of analyst recommendations. Let's start this one off with Chewy. Mizuho upgrading its recommendation on the pet food retailer to outperform, nudging the price target to 50 from 44. The analysts mentioning the recent pullback in the stock from highs and expectations for a, quote, strong quarterly results when the company reports later this week. Nevertheless, the share is down about 1% on the day. Next up, let's take a look at Canada Goose. TD Cowen upgrading the luxury Parker brand to buy, upping the price target by $3 Canadian to 25. TD Cowen saying new products should be on the way, and that should help drive sales growth. Those shares having a phenomenal day, up 12%. And finally, Bullish. Cantor Fitzgerald, bullish on the crypto exchange, initiating coverage with a recommendation of overweight, setting a $56 price target. Cantor is one of the more than 5 firms to initiate coverage of the stock less than a month after that $1.1 billion IPO. It's also worth mentioning that a slew of initiations on Bullish comes at its peers in the crypto space, including Gemini and Figure are set to price as soon as this week. Shares of Bullish, though, down about 4% on the day, and those are some of our top calls. I'm pleased to say that one of the analysts on that last call, Brett Knoblauch, joins us right now. He's crypto and digital assets research analyst over at Cantor. All right, so give us a skinny here. I mean, we talk about a company that I think got a lot of attention when it first came out of the gate. What separates it from some of the other players in this space, Brett?
Perfect. Thank you for having me. Really appreciate it. I think Bullish is really focused on serving institutional clients. I think a lot of the other exchanges you guys probably most commonly talk about service both institutions and retail, but when you look at what drives their profitability, it's really all retail, and that's where Bullish is really different, as it doesn't serve retail today. And when you look in the future and kind of where volumes are going to go, it's going to come from institutions. Right now, most big banks can't trade digital assets, so you want to do so through a exchange that is extremely regulated, extremely, I would say, inexpensive from a take rate perspective, and then has an extremely deep order book, which if you look at Bullish, it kind of has the deepest order book across all the exchanges across the world.
When you talk about the institutional side of this, I mean, this is relatively new, at least in terms of the growth of it. And we've seen that really get supercharged, certainly this year, Brett. Do you have any sort of sense of just how far that goes? Does this sort of end up becoming, at least on the institutional side, no different than any other major asset class out there?
Yeah, I think that's where it's going. We're certainly not there today. Speaking to our clients who are mainly focused on equities, very few of them have the capability to trade spot digital assets. So it's very, very early innings, and it's something that if you look out 5 years, I would be shocked if most of the major clients that we speak to today aren't or do not have exposure to that space.
And Brett, I do want to talk a little bit more about the competitive landscape here, because of course you have this overweight rating on Bullish, but you also cover Robinhood, for example. You have an overweight rating there, and you think about some of the other crypto exchanges that are out there. Coinbase, for example, you have an overweight rating there. And I understand that Bullish is more targeting the institutional side of things, and maybe that is their differentiation. But you think about how this could evolve. I mean, could you see a world where actually it's Coinbase and Bullish competing over the same customer set? Who wins in that scenario?
I don't think, I mean, certainly they're going to compete to some extent for the same clients, but I think the bigger competition story is Bullish and Coinbase competing against offshore exchanges. If you look at the global spot trading landscape for crypto, a lot of the volume happens offshore, whether it be Binance, Bybit, OKX. These offshore exchanges aren't as regulated as the exchanges in the US. So I think you're going to see share split over time from the offshore exchanges probably to those that are more regulated, because if you are an institutional client, like, you want to be trading on the most regulated and compliant exchanges. And I think that's where kind of share gains are going to go.
Well, it's a good reminder that we're talking about a truly global asset class here. You think about the cryptocurrency landscape. And Brett, I do want to dig into the influence of passive here, because in reading through your reasoning for why you went through with this upgrade, you cite that passive money is a powerful influence here. And I just want to dig into that a little bit deeper.
Yeah, Bullish is a bit unique as it has its exchange on one side of the business, but it also has CoinDesk indices, which it specializes in multi-coin indices and reference rates. And passive, I would say, investing across crypto has not really happened yet. And you look across traditional equity markets, and it's somewhere around 65% passive, if not more. We're probably at below 2% right now is passive. So I think Bullish is quite uniquely positioned to benefit from that. As you look at like S&P Global or NASDAQ or ICE, they all have indices business that generate a lot of asset-linked fees. And as more passive money comes into the space and tracks the indices that they are launching, CoinDesk 5, CoinDesk 20, you're going to see that business really take off. So it's another play on, call it the institutionalization or kind of maturation of this space. And that's where they are really unique, and no other really exchange has the multi-coin side of the index business.
All right, Brett, great to get some time with you. That is Brett Knoblauch. He is crypto and digital assets research analyst over at Cantor. Interesting, that last point that he made, that you think about the crypto market, it's still largely active. You've seen a lot of demand for products such as IBIT, which is BlackRock's passive ETF, but at $84 billion, that's still just a drop in the bucket.
And it kind of gets to this idea, though, too, particularly when it comes to Bullish, sort of when you talk about a business model that is a little bit different than what we've seen with some of the other crypto entrants, whether that ends up giving it an edge, Katie.
All right, coming up next, we're going to talk specifically about New York, with New York City's economy actually gaining momentum. Andrew Kimball joins us next. This is Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Katie Greifeld. Of course, just 30 minutes ago until the bells ring, looking at very slight gains.
Yeah, slight gains here, and this is kind of a market that's been in a little bit of a holding pattern. A lot of big questions right now about the health of this economy, about how the Fed will or maybe will not address that. And I think maybe when we get a little bit more clarity this week, CPI data, PPI data, a Fed meeting next week. But right now, everybody's still focused on that jobs report that we had last week, which of course wasn't very encouraging.
And of course, another update on the labor market tomorrow. We're going to get those BLS revisions. A little bit stale, but still more accurate, maybe. So certainly a big spotlight on the labor market.
And of course, those numbers kind of give us the broad picture of what's going on across the United States of America. But when you break it down into the individual states, and more importantly, the individual cities, there's a lot of variance out there. There's a message right now coming out of the monthly New York Fed survey that actually shows the prospects of finding a job within 3 months actually fell almost 5% in August. Now, that's the lowest reading since 2013 when the survey first started polling on that topic. The unsettling statistic further complicates the labor market backdrop as we await those revisions that Katie was just talking about. Joining us right now for his perspective, and maybe a little bit rosier perspective, is Andrew Kimball. He's the CEO of the New York City Economic Development Corporation. He joins us here in studio, too. Great to have you here.
Great to be here.
We all saw the numbers out of that national jobs report that we got on Friday. When you start to look at the data for New York City, it's not necessarily as dour as maybe what we learned on Friday.
Sure, it's been disappointing, the last couple of national jobs reports, and we've seen some of that data in New York as well. There's no question there's been a slowdown. We put these numbers out on a monthly basis ourselves. We draw from all sources and come up with a report. And that's important because it puts things in perspective. And the perspective is this: the fundamentals of the New York City economy have never been stronger. We have more private sector jobs than we've ever had, more total jobs than we've ever had. We have the highest workforce participation rate in the city's history. That's the percentage of people who have a job or are looking for jobs. 1 in 5 businesses have been created in New York City in the last year. That speaks to the backbone of our economy, which is small business. And young people are voting with their feet. They are coming here en masse, 570,000 just in the last 3 years alone. Recent college graduates, university graduates, they're joining another 500,000 in school here today. That's 1.3 million of our 8.5 million New Yorkers, all ready to fuel our innovation economy.
So when you sort of cite those statistics, I mean, we're talking about 2 big hits that we saw to the New York City economy. Obviously, the pandemic, which did a lot of damage. And then there was also the other issue of just sort of a migration, if you will, the idea that, you know, New York used to be the only place if you wanted a job in finance or in entertainment. And we've started to see that broaden out to places like Miami and Dallas, et cetera, here. Those factors have still allowed New York to still leapfrog and continue to grow? That's what you're telling me?
We got hit hard in COVID, no doubt. Lost 1 million jobs, lost several 100,000 people. But what is starting to turn now, certainly the jobs have already turned, right? We've gained back that full million and added 250,000, so record high for jobs. We had 87,000 net new people come to New York City last year. It's about 180,000 when you look at the metro area. That's more than Dallas, Miami, and Atlanta combined. So people, young people, are speaking with their feet, and then corporate leaders, business leaders, are voting with their checkbooks. They're investing in their companies. JP Morgan Chase, Deloitte, companies like OpenAI, Chobani, Bridgewater, all moving to New York City. Why? It's because this is where the young talent is.
Well, JP Morgan, out with that big new office building that we keep hearing about. So I take your point there. But let's talk a little bit more about private sector employment. I'm looking at data from the Partnership for New York City. They point out that employers added fewer than 1,000 jobs in the first half of the year. If you take out 2020 and what happened there, that is the fewest jobs added by the private sector since the Great Recession in 2009. So with that in mind, I mean, how do you kickstart that momentum once again?
Yeah, well, look, just to be clear, two bad reports on job numbers. We see it also in New York City. So things have slowed, but even during that period of time, adding people, right, and adding some jobs. A lot of it is what you said in your intro, which is we think the market is looking to see where things shake out on tariffs, interest rates, but the fundamentals, again, are very, very strong. You know, when I took this job 3.5 years ago, people were talking about doom loops and, you know, a worst economy since the 1970s. Nobody's talking about that anymore. And when you compare us nationally or even internationally, the fundamentals of the city's economy are very, very strong. So we're hopeful when things shake out a little bit on some of those unknowns that we'll see another burst in job growth.
Well, let's talk about the future and specifically what's happening in about 2 months. We have a very contentious mayoral election coming up in New York City. The front runner, one of them, of course, Zohran Mamdani. There is a lot of concern when it comes to the Wall Street crowd about what that is going to mean for New York City's economy. And I wonder where you fall in that debate.
I have 2 perspectives there. All the candidates talking about affordability. It is really critical, right? When you have all these young people moving here, people want to be in New York City. Our vacancy rate for housing is 1.4%. That means cost of living is higher. I'm really proud under this administration, it's not our direct purview, but that we have historic gains in both housing starts and in laying the roadmap through rezonings, historic rezonings, so that we can add up to 500,000 new units of housing. That will bring down the cost of living. And that's something that is shared by all of the candidates. The other thing I'll say is EDC has been around for 30 years, right? We were started with the goal of diversifying New York City's economy, and that's one of the key strengths. So not only do we have financial services, which continues to grow, and by the way, net new 25,000 financial services jobs since COVID, but in life sciences, in tech, in the green economy. Now with AI transforming everything on top of that, with 40,000 AI engineers here, we are positioned perfectly for the future.
But some of the concern, I mean, it isn't just Wall Street. You're hearing a lot from real estate developers. It isn't just about housing. It's about the gains, in fact, that you've made in terms of office space and office space occupancy, and whether that can actually continue. Do you start a new product if you are anticipating a major change in, I guess, the political winds?
I think what we've seen, and I'm really proud of the work this administration has done at laying a roadmap for the future through the New York plan, which said, look, there's going to be no more days of solely downtown offices or midtown offices. We need every neighborhood to be live, learn, work, and play. So what does that mean? That means we've been fueling the office market by supporting where we can high-end renovations. So that's where demand for space is extraordinary. We have the highest leasing rate since 2019, and it's mostly in high-end spaces. Deloitte going to Hudson Yards, JP Morgan Chase near Grand Central. So those pieces are in place for the city to grow.
Have you or anyone at the Economic Development Council Corporation had any conversations with the Mamdani campaign and potentially the Mamdani administration?
We are constantly in contact with people who are interested in seeing the economy grow. Again, EDC's been around for 30 years, from administration to administration. The baton is handed off, and we work very closely in that middle space between the public sector and the private sector, and we've been very effective at getting things done, and I'm very confident we'll continue to be able to do that.
Andrew, really appreciate you coming in. Great perspectives here on, of course, the financial capital of the world. Andrew Kimball is the CEO of the New York City Economic Development Corp. When we come back after the break, we turn back to public markets and we turn back to, well, one of the biggest gainers in the market today and, well, some of the biggest losers. It involves EchoStar and it involves a big sale to Elon Musk's SpaceX. It's our stock of the hour and it's coming up next here on Bloomberg.
Today's stock of the hour is EchoStar. Shares of the telecom giant soaring to an all-time high after the company agreed to sell $17 billion worth of spectrum licenses to Elon Musk's SpaceX. Now, this is shaping up to be a win-win. You have SpaceX's Starlink satellite internet network getting a substantial boost at the same time that EchoStar gets some debt relief and a potential resolution to a lingering regulatory probe. Let's bring in John Butler. He is senior telecommunication analyst for Bloomberg Intelligence. So a win-win, of course, for SpaceX and for EchoStar. We'll get to some of the losers from this in a minute, but talk to us about what problems this solves for EchoStar.
So I think you hit on the biggest problem for them, which is they were over-levered. And so I think the recent spectrum sales you've seen first to AT&T last week and then today to Starlink is going to go a long way towards allowing them to pay down debt. That's number one. Number two, they really had the FCC on their back here. EchoStar has been very slow to build out their wireless network. They have a treasure trove of spectrum there, but they have not. They've deployed it, but they haven't really filled it up with customers. And that was the problem that the agency had with them. And frankly, it was the problem that Starlink had with them. And they complained to the FCC about it. And they got the FCC to act in the sense that they really began to pressure the company to sell some spectrum. And that brings us to what we've seen over the past couple of weeks with some big spectrum sales by EchoStar.
So I am curious, John, about kind of what becomes of this spectrum. I know that SpaceX has been eager to get their hands on this, or at least they were very critical of the idea, in their words, that EchoStar hadn't made enough use of it. What exactly are they going to use it for? And are they going to use the full amount of what they have agreed to purchase?
So here's what I don't think people fully appreciate about that spectrum. There is the majority of what was sold today is called AWS-4. Different spectrum bands have different names, but the importance of AWS-4 is years ago, the FCC cleared it for multiple uses. They call it flexible use spectrum. And so Starlink can now use this AWS-4 to offer cell services directly from space, direct to consumer. In the past, without this spectrum, no matter how much spectrum they had, they would have to work through a terrestrial carrier like AT&T, Verizon, or T-Mobile to actually distribute the signal to end users. So they now have a direct route into competing as a carrier in the wireless network. I'm sorry, in the wireless industry.
All right, John, really appreciate getting some context here. That is John Butler. He is senior telecommunications analyst for Bloomberg Intelligence. A big day for EchoStar, of course, but then you take a look at shares of T-Mobile, Verizon, AT&T, all lower on the day. This isn't necessarily a win-win for some of those companies. Yeah, and this space is just so hard for me to wrap my head around, but I get this idea here that apparently now SpaceX gets to crowd out a lot of those folks from that. And we should point out this is basically one of the bigger movers, at least in terms of, when you go across the mid and small cap space. But I do want to just mention real quickly here, the S&P, you're not really seeing like the big tech names do a whole lot today. You got Uber up about 4%, Take-Two Interactive. I mean, those are kind of on a percentage basis, your leaders. But Broadcom. I love this story last week. Continuing the run, up 3% today. The Great Eight includes Broadcom. The close is up next. I know. This is Bloomberg.
Tech trade likely has more legs because investors are going to stay on edge this month for three reasons. Number one, September seasonality. Number two, Fed rate cuts that are coming. And number three, inflation data. But the good news is we're seeing 10-year yields start to moderate. That's good for tech stocks. Rate cuts are good for tech stocks. And that's why I would say don't bet against the U.S. I think tech continues to lead this market.
Saira Malik over at Nuveen kicking us off to the close just about 50 minutes ago with the market that's been in influx all day, but tech, once again, holding its own. It's either a growth story or it's a defense story or sometimes it's both. All we know is that the color is green, and you can see, to your point, tech is outperforming today. The NASDAQ 100 higher by about 0.4%. Certainly helps to have NVIDIA, Broadcom, Amazon higher on the day. The S&P 500 also higher, not by as much. Here you can see that most of the action, when you break it down to the individual stocks, is to the downside, but still the S&P 500 going to finish green. The bond market, this is interesting. The 10-year Treasury yield really has come down pretty mightily over the past couple weeks. And Euro USD, wanted to check in there. Of course, we're keeping an eye on French political turmoil, but the euro stronger against the dollar. I do want to go back, of course, to what you just said there, particularly when it comes to Broadcom, up for a fifth straight day at a record high. When you take a look at the tech trade, and more specifically the AI trade, those names continue to shine. But more importantly, you talk about investor appetite, and that appetite is going to be put to a test once again this week with a slew of new companies entering the market. Mark Lehmann is the CEO over at Citizens JMP, and he says the IPO window is open. He joins us right now here in Studio 2. Great to see you.
Thanks, Rooney.
We got several big names, potentially, I should say, coming to market this week, like Klarna, a couple of crypto firms. But we've seen a lot of big IPOs over the last few weeks. In a way that we didn't necessarily see at the start of this year. And I am curious as to what's facilitating that. Is it the idea that we just have a little bit more clarity and calmness with regards to Washington? Is it that markets, for one reason or another, just run out of things to buy, so they need something new? What's driving it?
I'd say yes to what you just said, the multitude of things. I think there's appetite. There's been a dearth of IPOs, particularly in tech, for 4 years. This is the busiest calendar in 4 years. That's factual. And I think these companies are earning this valuation, and they're actually performing as the company go public. So if you go to the class of IPOs, for the last 8 months, they've worked. And what a portfolio is like, past performance. And so you're going to see more of these deals, Romaine. They'll price in the next couple of weeks, and then you're going to see a slew of them by year end. And we should just point out for our viewers, I mean, you are actually based out there in kind of the heart of what we would call the tech world. I am in San Francisco, and I've been there for 30 years, and Citizens has a big presence there. And we see a lot of that capital formation continuing in there. And the AI trade is right there. It is right in San Francisco. When you talk about the vibe, and there's been a vibe shift on Wall Street that we've seen for a variety of reasons, are you seeing that vibe shift, particularly in the private space, meaning the venture capitalists and the other folks who are sitting on a plethora of unicorns? I remember the old days when if you had 10 unicorns, that was considered like a big deal, and now I've lost track of how many companies have billion-dollar valuations. Yeah, there's more than 1,000, and that's a big number. Whether they're ready to tap the public markets is a different question. I think the real issue for them is, have they come up with a formulation of a strategy? When they raised their money in 2021, they didn't talk about their AI strategy. Now that's slide one. And if you have that slide answered, you've checked that box, you're going to get that kind of valuation you deserve or you think you deserve. Yeah. And the public markets want to see more of those. I mean, look at Broadcom last week. Yeah. It gained $250 billion. It gained 2 snowflakes last week. Think about that. Yeah. And it's up again today. Yeah. So that's really telling. And people want to see that because they're kind of looking at their top 10 and saying, what's going to replace those?
Well, Mark, you make an important point that, performance matters here, past performance. If you see a lot of IPOs come to the forefront and perform well, that's going to beget more companies tapping the public markets. But I'll ask you the pessimistic question. How can you be confident that this isn't just another false dawn? Because it feels like we've been here before, that maybe we start to see another uptick in activity and then it inevitably fizzles out. What is different this time?
Well, I think you have to be cautious. I think we have seen this before. I was talking to my son earlier today about that. I mean, in 1999 and 2000, the cover of Barron said Amazon.bomb. And we've seen that before. And sure, they were partially right about some of those companies who did not deserve to go public, but did because the appetite was so much fervent back then as it is somewhat now. But I do think there's a slight difference today with the companies that are going. They're much larger companies. They have profitability in their front window. And they're also tapping these markets. They're so extraordinary, that are so much bigger. This is the second coming. This is this wave, and we're so in its infancy. And as trite as that sounds, it's true.
All right, this is the second coming. I like that. But I do wonder how much pressure is on these companies to go public, because often when we speak about IPOs and companies in the pipeline, we talk about it as if it's solely their decision. But you think about some of the early investors in these companies, how eager are they to get some liquidity and some return?
It's the right question. I think it really depends on a variety of factors. There are some of these private companies who can infinitely access the public markets. You look at SpaceX and OpenAI and some of these others, that Anthropic, Stripe, Databricks, and others that just continually raise at bigger numbers. That is a really wonderful backdrop for some of those companies. It's not for all of the companies. And I think there are these investors who have been landlocked with some of these investments for some time now that do see this path for the first time. They've really seen it for the first time. Rates are where they're at in the 4 zip code. They want to access the public markets and see those valuations.
I am curious about the existing valuations in the private space and how that transfers into an IPO. I mean, it's one thing to digest a company that's trying to raise $1 billion, but when you see these eye-popping valuations for an Anthropic and OpenAI, I know they're only going to sell a piece of it, but I don't know, is there any parallel where we've seen companies of that size try to come into the public market? What does that look like?
I mean, we saw some of these do this in 2021, 2020, who raised money then and tried to find that valuation umbrella. That did not work out particularly well for them. But again, those were not in this realm. They were beneficiaries from COVID. They were beneficiaries from low rates. They were beneficiaries of big capital. I'm sure some of these companies will see these eye-popping valuations be merited. I'm sure that there'll also be some that you're going to look back and say, my gosh, they got a 10, 20, $50 billion valuation. They don't anymore. And that's part of the portfolio theory of some of these investors. I think you're seeing that.
And I know a lot of people are trying to make comparisons between what we're going through now and what sort of happened in the mid to late 90s. And this big debate is today the equivalent of 1999 when the bubble began to burst, or is it kind of 1996 when things were still going swimmingly? I am curious as to whether that's a proper way to look at this. When you look at AI and just all the technology that feeds into it, and more importantly, I guess more importantly, the things that AI can sort of reach, do you see it as being a bigger deal than what the advent of the internet and e-commerce and all that came out of the 90s?
I think about it all the time. I was around for then, as you can probably tell from my gray hair. I think the multitude of companies who came out with very little of a business strategy and very much on the come. Obviously, in hindsight, I always say hindsight's 2010. It's more acute than 2020. I think these companies today are much more seasoned. They're much better capitalized. The valuations may be ahead of themselves. The companies are not. And I think these companies have much better foundations, much better management. We've also had a 4-year drought, right? We haven't had this nonstop window that's been open for 5 years. That's not been the case. So I think these companies are better prepared for a public following, and their boards and everybody else knows what could go wrong, and they don't want to be that one.
The window is open, the breeze is blowing. I do want to get your thoughts on a theory that I've heard for why we've had this 4-year drought and why it's ending now, is that the idea is that you have these big tech companies being some of the last true conglomerates, that maybe you do have IPO candidates in the tech space, in the AI space, and then you just have the Magnificent Seven, those giant companies just buying up those companies before they have a chance to consider the public market. How much water should we put into that idea?
I mean, they've been big acquirers. Obviously, Meta's made a bunch of acquisitions. Microsoft, all those have. I think that is part of the notion, but I think what we just discussed is also a much bigger part of that. These companies really, they garner these valuations that people frankly have a hangover from even 4 years ago. And I think this ascent to the public markets where it's at today, and having digested the rate rise of the last 4 years and some of the tariff noise that's now behind us, hopefully, they're looking for new things. They are really looking for new ideas that are because this, again, I don't want to be that person, but I'm going to be that person. This is the second coming. We're watching it real time. It's going to change everything that we do, from healthcare to technology to consumer to every part of our life, to banking, everything we do. That's what's going to happen.
We are, of course, about 30 seconds from the closing bells here in New York. Mark, I do just want to get your thoughts here. We have a market, of course, coming off of a record high for the S&P last week, and most of the other major indices, if not at record highs, certainly not far off of them. What do you think sort of propels the public markets right now to fresh record highs? Is that going to be a corporate earnings story, or is it going to be much more about what's going on with regards to rates and macro conditions?
I think it's a lot to do with performance. I mean, we have this valuation umbrella that we're pushing to the bounds. And I think if people don't see these kind of earnings, we run the risk, if those earnings don't keep up with rates where they're at, that we're going to see something in terms of an air pocket. But I think these companies are going to keep performing, especially the companies that are beneficiary of AI.
In conversation right now with Mark Lehmann, Citizens JMP, as we get to closing bells in New York. The Dow Jones Industrial Average up about 0.25% on the day. Similar moves higher for the S&P 500, back close to that 6,500 level. The NASDAQ Composite up about 98 points, or 0.5% on the day. And the Russell 2000, your relative laggard, still a gain, basically 4 points higher on the day, or 0.2%. Joining us right now around the table, we want to bring in Bailey Lipschultz, who helps to cover cross assets for us here at Bloomberg, and Jonathan Levin, Bloomberg opinion columnist. And I'll start with you, Bailey. I mean, we talk about a market right now that is kind of perched on the precipice of another record high. And does that next record high, is that dependent on the macro data we get this week?
I think so. I think we do get their jobs revision. What happens with both the PPI and CPI will paint a picture for at least investors to have a better sense of where the Fed is going to go in terms of one cut or a slew of interest rate cuts. And really, is that being driven by inflation remaining sticky, or are we actually getting a sense that the economy may be in a better position to kind of adjust to some of those rate cuts?
And Mark, I just want to give you let you go and give you the last word here. When we get to the Fed meeting next week, and I know there's been a lot of talk about what happens in September. I'm more curious about what happens after September, whether this is the start of an actual rate cutting cycle, and if that does materialize, is that a net positive for equities?
Well, I think it's a necessity. I think if it doesn't happen, I'll give you the corollary, that's a problem. And I think we're seeing some of that data continually be weaker, and I think that calls for that kind of rate cut environment. But if that doesn't happen, and I think you're seeing, Romaine, some of these deals pricing between now and next Thursday, that's happening real time. And I think you're going to see these people want to get ahead of it. The convert market is like that, hot. You're going to see a bunch of deals come in the next 8-9 days. So they're expecting it. If it does not happen, I'd be much more pessimistic about the options for the NASDAQ and others to make new highs.
Mark Lehmann is the CEO over at Citizens JMP here in New York, with us fresh off of, a lifetime in this space out west there in San Francisco. We continue our coverage here of the market close on Bloomberg Television. Romaine Bostick alongside Katie Greifeld, Bailey Lipschultz at the desk, and down in Miami, I guess he's got the better job of the two, although it's a pretty nice day here in New York, Jonathan Levin, Bloomberg opinion columnist. And Jonathan, I want to pick up where Mark left off, the idea of sentiment in the market, certainly for if you're a banker on Wall Street or whether you're a VC out in San Francisco. I am curious as to how that plays into more of the retail sentiment and, of course, the consumer sentiment out there that we're going to get a read on later this week.
Yeah, well, I mean, I really think that, the fireworks are going to start tomorrow, Romaine, with the benchmark revision on jobs. The big question here, and I think you see that's playing out in the dichotomy between the action in the bond market and the stock market today, is, we have this impression that the labor market is weakening, but is it weakening sort of just enough to give us those sort of rate cuts, or is it weakening a little bit too much? I think that that's what everybody wants to know, from the institutionals to the retail players out there.
Well, it was interesting to see last week all of the jobs data that we got kind of pointing in the same direction, from initial jobless claims to ADP to NFP. We'll get those BLS revisions tomorrow. But let's take a look at the sector breakdown on this Monday trading session. Big tech was the big gainer today. You can see the tech sector up about 0.7%. That is what that bright green is on the circle. Consumer discretionary also having a good day to start the week. What didn't do too hot today, utilities down about 1% at the sector level. Real estate and communication services also lower, but certainly there were a lot of gainers today.
Katie, a lot of gainers. You're talking about strength for tech in the S&P 500. Let's talk about two stocks that will be joining the S&P 500. Those are Robinhood and AppLovin, two of the best performing stocks with a market cap above $5 billion today. So we're seeing record highs for both companies. This again on the news that they will be joining the S&P 500 in 2 weeks' time. So investors, whether they're getting ahead of that or kind of the broader optimism around the outlook for some of these companies, but really buying before the systematic buying does flow in. Also want to call out some strength for EchoStar, ticker SATS. That stock closing at a record high of its own, this coming after Elon Musk's SpaceX striking a deal to acquire wireless spectrum for the company for about $17 billion, $8.5 billion in cash, and up to $8.5 billion in SpaceX stocks. Guys, SpaceX not publicly traded, so could this become a weird ARB play? Certainly something that may be on the top of mind for ARB desks around the world.
All right, and we're taking a look at the decliners too out there. What's going on there?
Yeah, so I had a lot to choose from because, of course, the breadth was pretty bad on this green day. I'm going to take you over to the flip side of the Starlink story. So we have wireless carriers T-Mobile, that's TMUS, Verizon, ticker VZ, and AT&T, the ticker is T. They're declining, between 2 and 4% apiece, all slumping on this news of Starlink acquiring that wireless spectrum from EchoStar. Recall that Starlink had been in partnership with T-Mobile, but this deal sort of brings into question Starlink's ongoing need for that sort of partnership. And more broadly, there's this sense that Starlink could really shake up the mobile business here. Moving along, I want to take you over to PepsiCo, that's ticker PEP. Down a little bit more than 3% on the day. Market is trying to size up this Elliott Investment Management agenda at the company. Elliott has disclosed, of course, a significant stake and is pushing for a big shakeup. But the campaign, I think, may also be focusing attention on all of PepsiCo's shortcomings, including its losing ground to peers Coke and Keurig Dr. Pepper. Elliott apparently wants PepsiCo to take a close look at its portfolio. And finally, I want to take you over to CVS Health. Down just around 5%. Investors were disappointed about the lack of new details about CVS's government quality rating. As Bloomberg's Ike Swetlitz reports, those ratings, known as stars, affect how much money insurance companies get through Medicare Advantage and Part D. So at the end of the day, that's affecting CVS's bottom line through its insurance business.
I just want a quick check on rates here. Basically, we saw a drop along the curve, but this time something that we haven't actually seen in several days. It was longer duration that had the biggest drop. Take a look at that 30-year yield, 469 and change, and that's significant for a couple of reasons. Of course, it was just a few days ago we were talking about potentially a 30-year yield going back above 5%. It has slipped back below that, and more importantly, back below its 200-day moving average for the first time in several months. And of course, that's going to be a big part of the story over the next few days, guys, as we get more economic data ahead of the Fed rate decision in about 1 week time. I do want to turn back, though, to one other equity story that caught my eye, and that was the trading that we saw a little bit earlier today in Siri, S-I-R-I, Sirius XM, on the news that maybe wasn't news, that Howard Stern was actually going to leave Sirius XM.
Perhaps
did you guys see this?
Fake news. I did see this. Apparently, Andy Cohen took over the mic at 7 a.m. on Monday morning. I don't listen to Howard Stern, I have to say. I don't know if that's surprising, but Andy Cohen, a real rascal here. But apparently, Howard Stern is staying on Sirius XM, though they haven't officially confirmed the contract.
So this was a hoax, right? It was just a joke. But it sent the shares down. I mean, the shares dropped like more than 5%.
We saw the shares down under pressure in light trading this morning after that Variety report that they were potentially canceling it, turning out that it is in fact a hoax. I don't want to say market manipulation, but kind of weird when we do see stocks reacting to this news. And it's funny and it's all fun and games and it's not April 1st, but you do see real money being made and lost potentially.
Jonathan, did this just rile you from bed this morning when you heard about it?
You know, I mean, Howard is Sirius XM at the end of the day. I understand the business model is changing. They're all about podcasts and so forth these days, bringing in Trevor Noah and new talent and so forth. But I mean, this is the guy that made Sirius XM the company and the stock that it is. So, you know, come on, give him some credit. Yeah, that is a good point. A lot of people forget that Sirius XM was just kind of a nothing. I mean, it was out there, but not a lot of people had it. And then when Howard Stern was made that huge switch from terrestrial radio to Sirius XM, you saw Sirius X, or Siri, as it was called back then, Sirius really sort of take off. We saw the shares drop this morning. They rebounded nicely and actually closed out the day higher by about 1.5%. Our thanks there to Jonathan Levin down there in Miami. Bailey Lipschultz up here in New York. Romaine Bostick alongside Katie Greifeld. We're actually sticking around here. A lot more to cover here on Bloomberg Television. Stick with us. We'll be back in a moment.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostick. An interesting day on Wall Street. You can call the price action tepid if you will. This is a market that continues to creep higher. The S&P 500 trying to get back to that 6,500 level, up about 0.2% here on the day. You did see a significant drop in yield, so we have the 2-year down, 1 basis point on the day, but the real action was on the longer end of the curve. A big drop there that seems to sort of presage maybe potentially something could be afoot. Take a look at the big moves that we saw in the Argentine peso, a big drop versus the dollar here. And of course, we talk about the individual stocks on the day. You saw some big moves, particularly with some big entrants into the S&P.
Yeah, absolutely. That's where I wanted to go. You can see that Robinhood and Levin, some of the names that made the cut, S&P, Dow Jones indices announced the names that would be added in their latest quarterly rebalance on Friday night. You can see that's really giving a bid to those names, as now they'll have trillions of dollars theoretically in passive money aimed at these companies. So that's the good news. On the bad news side, strategy. Michael Saylor's strategy did not make the cut. There had been a lot of speculation over the past couple months that it would be added to the S&P 500. It did not get the nod on Friday, so you can see shares falling a little bit today.
Keeping an eye, of course, on what's going on here in U.S. and how it folds into the broader global picture. We should point out this was a day where we did see European stocks, believe it or not, outperform the U.S., and we saw emerging market stocks outperform the U.S. as well. A big macro week with a lot of data in the U.S. and a big ECB rate decision in Europe. Kathryn Rooney Vera joins us right now, the chief market strategist at StoneX Group. And Kathryn, I do want to start here with this slew of economic data that we're going to get this week in the U.S., kind of the prelude to the Fed's meeting next week. And of course, on the heels of that big jobs report that we got last week, that certainly created, I guess, to certain people, a bit of disappointment.
Certainly does, and I think everyone expects the Fed to cut 25, maybe 50, probably 3 times 75 this year. But what happens next year? And I think what the main focus, at least from StoneX, is where is the neutral rate? The Fed anticipates that it's about 3%. What if it's potentially 4? I mean, we see financial conditions very easy. We see credit spreads extremely tight. We see the S&P near record highs. So that tells me that the neutral rate could perhaps be higher than what the Fed anticipates. And the implication there, Romaine, is that there could be a policy mistake in the offing of doing too much too fast, and then having to. The worst thing for a monetary policy entity is to have to reverse course.
And of course, that's been a big debate, particularly with all of the pressure coming from the Trump administration and the idea, at least in the president's mind, that the ECB has sort of gone the lengths already that maybe he wants to see here in the U.S. You know, I should point out, though, we came into this week with an expectation of focusing on the U.S., but a lot happened over the weekend overseas, in Japan, obviously today in France, but Indonesia, and Argentina as well here. There's been a big focus right now on whether there is a viable alternative to U.S. assets. I should say a reliable and consistent alternative to U.S. assets. And I am curious if you found any sort of potential sort of follow through on what we saw earlier this year, which was that sort of outside the U.S., find assets and move.
I would probably rephrase it, Romaine, as saying rather than a viable alternative to U.S. assets, where can I get more bang for my buck and juice? Because the S&P has done well, but the Brazilian Bovespa is up 30%. Europe is up 30%. So it's a market outperformance from international markets versus the U.S. So I do think that there are opportunities for more value at hunting outside. And in fact, I was on with you August 1st when the president announced the 50% tariff on Brazil. And I said, buy Brazil. And Brazil's up in another 11% since that day. Just to give one example, Brazil has a 15% Selic rate. It's the highest real rate in large countries. So you can get some attractive pricing. And the truth is that a weak dollar, dual deficits, the fiscal and monetary side in the U.S., and lower rates in the developed world are all tailwinds for emerging markets. So I do think there are some opportunities, especially in the likes of Brazil, emerging Asia as well.
So I hear what you're saying, and we've been listening to bullish arguments when it comes to Europe, when it comes to emerging markets all year, but it feels like especially with U.S. investors, that home bias is so strong. So how do you socialize and convince your clients that now really is the time that we should be looking outside the U.S.?
The good news, Katie, is at the beginning of the year, we recommended long European stocks in general. So we're saying unwind that trade and be selective with sectors. One of the sectors that we like in-house is utilities. You're seeing Europe move a little less green and more towards nuclear energy and the like. So I do think utilities trading where they're trading 4 times cash, I think is very cheap. So you have to be selective in some of these places. But I do think that the upside is potentially limited in the U.S. Maybe we go another 10%. But there's a lot more room to run in foreign countries, especially if, in fact, their currencies are going to appreciate versus the United States, which I do think the dollar is probably going to see a little bit more downside over the next 6 to 12 months.
Yeah, after a lot of downside that we've seen in the last 6 to 12 months. Kathryn, great to get some time with you. Great to see you in studio. That is Kathryn Rooney Vera. She is Chief Market Strategist over at StoneX Group.
Meanwhile, turning back to the U.S., shares of Dell lower in the after-hours trade. Its CFO, Yvonne McGill, is said to be resigning. We're actually now getting that crossing the wire here. The company confirming that the chief financial officer, Yvonne McGill, is stepping down and will be replaced on an interim basis by David Kennedy, a senior vice president with the firm. We should point out McGill has been with Dell since at least the 1990s in a variety of financial roles, including most recently as CFO. We'll get you some more details on that, and we'll be back after the break. This is Bloomberg.
Well, the Food and Drug Administration in August dramatically narrowing approval for the new COVID-19 shots, leaving millions of Americans uncertain about vaccine access as rules shift and political rhetoric escalates. Let's bring in now Dr. Marty Makary. He is Commissioner of the Food and Drug Administration. Doctor, great to have you with us.
Good to be with you.
So let's talk about that uncertainty, as I mentioned. What is the position of this administration when it comes to mRNA vaccines?
Well, first of all, I'd say that narrative is not correct. We didn't dramatically narrow it. We caught up with the rest of the world that is using a risk-based approach. So the COVID vaccine is approved for individuals over 65 and people with a risk factor. That's catching up with the rest of the world. In France, you have to be 80 or high risk. In the UK, you have to be 75 and high risk. So the world has moved on to a risk-based approach. And we're basically saying that if we were going to give an indication to a drug company to have a vaccine for young, healthy children, we want to see a clinical trial. That's our tried and true standard.
So just to crystallize that point, are you saying then the position is that they're unsafe, that basically for certain groups that you can't give a blanket recommendation that this is something that is safe after what we saw in the COVID vaccine?
No, if somebody wants a COVID vaccine, they can get it. We've approved the updated COVID vaccines, 2 mRNA vaccines and 1 traditional vaccine by Novavax. They're available. People can get it. But we're saying that our job at the FDA, according to congressional statute, is to approve claims by a pharmaceutical company based on the data that they send to us. So if they're sending us no clinical data on young, healthy individuals, we're not going to just blindly rubber stamp them every year. Now, the companies have agreed to go back and check in with a clinical trial. We think it's about time. It's been 4 years since a clinical trial has been done in healthy individuals with the COVID vaccine. Should a 6-year-old get 70 more COVID shots in her lifespan? That's a scientific unknown, and we'd like the answer to that question.
Is that type of revisiting in terms of doing trials on a drug that's already been approved. Is that something that's typical?
Well, look, the emergency is over for COVID, and it's a different time. It's a different virus. It's different virulence. It does not have the same infection fatality rate. There's broad population immunity. And with every new...
And that's cause for celebration. I mean, that was
a good thing.
I mean, that was probably one of the biggest scientific moments, at least in our lifetimes, on a health basis in this country.
Absolutely, Romaine.
Yeah.
I was urging the schools to get shut down and for lockdowns back, and trying to warn the country that this was going to hit this country as hard as it was hitting Italy and China. And, you know, it fell on deaf ears to some degree. But once we started to see the 10,000-fold difference in risk between a young, healthy individual and an older individual with a comorbid condition, you have to pivot based on the data that rolls in. So, look, we're in a much better spot. COVID is basically relegated to the same sort of seasonality as the common cold. That's a good thing. At the FDA, we're focused on a universal influenza shot, so we don't have to guess every year. We're moving on to bigger things right now.
Well, let's talk about where we stand right now, because according to Bloomberg News reporting, even after the FDA approved COVID vaccines for people 65 years or older, and if they have if you have a pre-existing condition, that there is some difficulty getting approved. This is according to our reporting, and it just speaks again to that uncertainty that I mentioned. So with that in mind, I mean, what is the FDA's plan forward? Do you have any plans to issue new guidelines to alleviate some of that confusion?
Well, first of all, there's no regulatory hurdle for somebody to get the COVID shot. So, yes, we are moving towards the model that they have in Europe, which is it's recommended based on your risk profile. But at the same time, there's no regulatory barrier. In some states, a young, healthy individual where it's taken off-label, the pharmacy may require a prescription by a physician. But look, it's widely available. I think that's a false narrative that it's hard to get. It's not available in every Starbucks, but you can get it in almost every pharmacy. Kaiser covers it. Blue Cross Blue Shield of Michigan covers it. Other Blues covers it. Medicare covers it. Medicaid covers it. So it's widely available and widely covered.
I do want to shift gears a little bit and talk about actual food and drugs, especially when it comes to artificial dyes and things along those lines as well, because that was a big position in the Trump administration's campaign. But that's another place where you've seen some inconsistency when it comes to regulations. So at this stage, I mean, what is the overall mission there?
Look, I don't see inconsistencies. I see dramatic success around topics that nobody has been talking about for 50 years. That is the removal of all 9 petroleum-based dyes from the U.S. food supply, something we did at the FDA. We're moving forward. We're addressing the root causes of our childhood chronic disease epidemic. 40% of the kids in the U.S. are sick with a chronic disease. The solution is not more Ozempic for 6-year-olds. We have to talk about school lunch programs and SNAP waivers so that food stamp programs are not paying for junk food and sugary drinks. So these are revolutionary, dramatic reforms that we've seen in the Trump administration, thanks to the leadership of Secretary Kennedy, and we're doing it. We're rewriting the food pyramid. That was misinformation. That did a tremendous amount of damage. And we're ending the 50-year war on natural saturated fat. That's not the cause of our heart disease epidemic. We're talking about ultra-processed foods now and the types of grains people get in their diets.
I am curious, Marty. I've covered the FDA for years. I started my career doing this years ago. There's obviously a lot of interest in how things get improved, sort of the process behind the scenes. I know a lot of the PDUFA meetings, at least in the old days, would get broadcast, and you could see what's going on. Last week, you guys basically released more data, or at least basically said, we're going to release more of the response letters so people can see what got or what didn't get approved, and more importantly, why it didn't get approved. Are you going to continue to do that? And is there a selectivity in what you're choosing to release?
So, yeah, we released the last year and a half of FDA rejection letters, known in the industry as CRL letters. Yeah. And we're going to keep releasing them in real time because the public deserves to know why we don't approve a drug if we don't approve a drug. Now, look, I want to see more cures and meaningful treatments. We're on track for perhaps a record number of approvals this year in our time in the history of the FDA. But if we don't approve a drug, right now, companies spin why they're not approved.
Yes.
And so what we want to do is be very transparent, and the individuals can see that there were safety manufacturing violations, that the clinical trial found no benefit in the primary or secondary endpoints. People deserve to know why, so we're moving towards transparency.
With regards to new approvals going forward, there has been some concern about the pace of those, potential pace, I should say, of those approvals, given the contraction in the labor force at the FDA. Now, over 1,000 jobs, positions have already been eliminated. How much can you ensure the drug makers that when they do submit an application, that it will be taken up in a timely manner?
Well, I'm glad you asked, Romaine, because we want a more efficient FDA. We want a modernized FDA, a more streamlined FDA, cut the red tape, and we want it to work like a well-oiled machine. We did have cuts where we had consolidations of IT and HR people. We had no layoffs or cuts to scientific reviewers. And that is the workhorse and our inspectors. So you're going to see, I believe this year, a record number of approvals in the shortest average time in the history of the FDA. We've got a new pilot program to get a decision out in weeks.
Will that process be as thorough as the past?
Absolutely.
Because we're talking about life and death here for some of these drugs.
Absolutely. Yeah. We cannot cut any corners on safety. But what you're going to see is instead of this broken, decentralized process of we get an application and then send it around to a dozen offices and each one gets months to get back to us, you're going to see a convening, and we're going to have an incredibly efficient process, like a tumor board. Look, I was a surgeon at Johns Hopkins. We had to make decisions based on the information at hand. You're going to see a radical number of cures.
Are these decisions going to be made, though, I guess, more or less from the bottom up, by the scientists, by the doctors there, or is this coming down from the top at HHS?
Absolutely. It's going to be made by the scientific staff at the agency. The process will be the same, but we're going to cut the idle time. For example, why are we reviewing your manufacturing data after your clinical trial is complete? We can do that while you're doing your clinical trial and then just read out to us the clinical trial results, and we got the lion's share of the application done already. So we're going to see an efficient, streamlined, modernized FDA that uses AI as well.
So more approvals coming down the pike in the months ahead. Let's talk about reports, though, because we saw the Wall Street Journal reporting on Friday that the federal government is going to release findings of causes for autism in the coming months or so. That sent a shockwave through shares of Kenvue, for example, because it's likely, according to Wall Street Journal reporting, to say that over-the-counter pain medicine with acetaminophen, which is the active ingredient in Tylenol, may cause autism. So the question is, when are we going to see those findings? And can you speak to this Wall Street Journal report?
Look, I think within a month we're going to have our report on autism because it's a massive priority for this president and this secretary. And they've said, look, we have an epidemic of autism in the United States. Nobody's talking about the root causes. We not only want to talk about root causes, but what parents can do. We've got millions of kids with autism in the United States. 1 in 20 boys in California. So we've got to bring attention to this issue. Now, the Wall Street Journal reporting on Tylenol, that was incredibly premature. We haven't even written the report yet, so I don't know how they can put that out there. But there was a Harvard study that looked at autism and Tylenol, and perhaps they were speculating that it was that study that would be incorporated in the report. We're looking at everything. And Tylenol is not the central piece of the report, but we are looking at every piece of data.
But there will be balance in whatever determination you make, because when people see the Tylenol thing, you know, we talk about pregnant women. I mean, most doctors tell them that's the only pain medication you're supposed to take when you're pregnant. So if that becomes a risk, or you determine that that's a risk for autism, is there going to be an alternative that can be proposed?
Well, first of all, we didn't put out there that Tylenol causes autism. We're reviewing the data. We haven't started the report yet. Most fevers in kids do not need to be treated. You know, in the medical field, every time I get a call, hey, this patient has a fever, I went ahead and treated them with Tylenol. Why? Why are we doing that? It's only in a small subset of patients where you actually need to treat the fever. The fever is the body's natural way of ridding the infection. And when you treat a fever in a young, healthy kid, there's research, including out of my former institution, Johns Hopkins, it can actually prolong the illness with chickenpox. That's a study out of Hopkins. So we need more clinical appropriateness with these medications. I think you're going to see some amazing things that have not been discussed in this report on autism.
All right, Dr. Makary, really appreciate you taking time for us.
Good to be with you guys.
Dr. Marty Makary is the Commissioner of the U.S. Food and Drug Administration. And Katie, of course, I'm glad you brought up the Kenvue thing. I kind of forgot about the big drop that we had seen last week on that report. We should say, citing confidential information that there might be, the administration might be trying to draw a link with acetaminophen. And of course, that sent the shares down. So this has a lot of implications for a lot of folks.
Yeah, absolutely. I mean, again, just focusing on Kenvue, shares dropping more than 9% on Friday alone, falling another 1% today. Of course, Dr. Makary saying that that was premature, but we will get the findings of that report in the next month or so. So certainly going to be consequential.
Yeah, great conversation. Of course, we cover a lot here on The Close, from what's going on Wall Street to Washington. We do want to turn back to Wall Street now, and specifically into private markets, private credit markets to be specific. They're in the spotlight today as two firms are joining forces to try to bring a bit more transparency to this space. Financial company Kroll launching a new tool with investment firm StepStone called, quote, Benchmarks. It's designed to enable users to identify, analyze, and model valuation drivers of multiple asset classes. And I'm pleased to say that the CEO of Kroll, global provider of financial and risk advisory solutions, joins us right now, Jake Silverman. Great to see you, Jake.
Thank you, Romain. Thank you, Katie.
You got my attention with transparency. So, when you talk about the evolution of financial markets over the years, from the old days, and I mean the old days of equities, which were kind of closed off, to even more recently with the bond market, which used to be very opaque, a lot of people are looking at private markets right now and saying, how can I be confident that what the CEOs of some of these firms are telling us about the state of those companies? Does this tool help?
That's exactly what this tool is supposed to accomplish for this growing but still young market. We at Kroll, with our fantastic partners at StepStone, really focused on building a state-of-the-art benchmark that is really the first of its kind, bringing together 15,000 deals across the private credit landscape to provide insight, to provide transparency, and to really facilitate the growth and the proper functioning of this very, very important market, the private credit markets.
Where is the data coming from?
The data is coming from the actual issuers. Okay. Importantly, and this is something that is very, very top of mind for every market participant, the data is aggregated and anonymized. This is a highly secure, anonymized benchmark, but it's at the granular issuer level as opposed to the portfolio level. And that's what makes it even that much more relevant and that much more actionable.
From where you're sitting, how much more work is required to evaluate a private credit, a private security versus a public security? I mean, private is in the name, so I would imagine you have to do a little bit more digging there.
There's a significant amount of research that goes into analyzing every private credit, every private asset that is part of this benchmark. So it's not as easy as looking at the ticker and pulling up a news story. There's a fair amount, significant amount of real diagnosis and interrogation of the pedigree information that we have pulled together over decades with our analysts within Kroll, and we're the largest valuation firm in the world, and our great partner at StepStone, who are over a $700 billion advisor to the private markets. So our ability to pull all of this information together with real in-depth research at the aggregated anonymized level is unique in the market.
Is the bottoms-up process, though, for evaluating a private credit versus a public credit any different? I mean, are you actually going to the buildings, knocking on doors, talking to the executives for some of these private securities?
Well, there's just basic fundamental valuation analysis that is pulled together from a number of sources. Some of it's macro sources, some of it is from the issuer itself, and we pull all of that together to actually create this aggregated benchmark.
I do have to ask you about this whole push to move or to allow greater access in private investments by, I guess, the retail trader, for lack of a better phrase. The idea of introducing this into 401ks and other retirement plans, and even just allowing just rank and file people to go in and pick and choose what they want. Does a tool like this help them?
Absolutely. This tool will really help facilitate access and understanding and insight into this market. You're absolutely right. What I characterize as the retailification of the private markets is absolutely happening. The largest asset gatherers in the world are focused on making private markets available to the mass market. And this tool, this benchmark, as I said, unique in the space, will enable real insight for any type of investor, any type of market participant.
There's been, of course, a lot of concerns about whether this sort of a new group of potential investors is going to, forgive the phrasing, be qualified enough to pick and choose in this space. Is there a sense, in terms of what you're working with regards to StepStone, and more importantly, working with the issuers here, that they want that greater transparency on their end for the retail investors?
At the end of the day, I believe investors certainly want transparency, and issuers and people who are and institutions who are creating these types of products want to make sure that those products are actually made available to the retail marketplace. And so the ability to facilitate matching requires a level of insight and transparency. So the more that we can provide that insight to the marketplace, the more access there will be, and the more safety there will be for a $1 trillion plus marketplace that is rapidly growing.
Very interesting move, really a sign of the times in terms of where we stand between public and private markets. Jake, it's great to get some time with you. That is Jake Silverman. He is the CEO of Kroll. Meanwhile, let's take a look at shares of Dell and Kenvue. Of course, a lot of after-hours action there. We start with Dell right now, down about 2%. We got the news earlier this hour that CFO Yvonne McGill will resign. That will be effective September 9th. You can see that shares reacting there. They have begun a search for a permanent CFO, but Dell has named David Kennedy as the interim CFO. We also wanted to take a look at shares of Kenvue. We mentioned, of course, it was down in a big way on Friday, down about 9%, another 1% today. The Wall Street Journal reporting that an upcoming report from the federal government will link the active ingredient in Tylenol to autism. We were just speaking, of course, with FDA Commissioner Dr. Marty Makary, who said that the report on autism is coming within a month. It has not written that report yet, but said that Tylenol will not be the focus. Initially, you saw Kenvue shares higher by about 1.5% after those comments, now unchanged as investors parse through what this could mean. We'll talk all about it next. This is The Close on Bloomberg. Well, Apple's biggest product launch of the year is on deck, with the company set to debut its next generation iPhone lineup and new smartwatches tomorrow. Joining us now is Mark Gurman. He is managing editor of consumer tech over at Bloomberg. Talk to me about the thin iPhone, Mark.
Yeah, the thin iPhone, that's going to be the heart of the discussion on Tuesday, the so-called iPhone Air. It's about a third thinner on paper than the current iPhones, but the current iPhones aren't necessarily very thick, right, or unwieldy. So this is going to be a big improvement in terms of thinness. It's going to excite some people, but that will come with some drawbacks. Obviously, a thinner frame means a thinner battery, which means less battery life. So that's going to be a bit of a drawback there. One camera on the back. And so that is going to be another drawback compared to the 2 cameras you get on the base model or the 3 cameras you get on the Pro models. In terms of what we're expecting, those phones, in addition to the Pro phones, the base level iPhone 17, you'll see the 3rd generation AirPods Pro, and then you'll see upgrades to all 3 Apple Watches, the Series models, the Ultra models, and the SE models.
Just real quickly, though, Mark, I mean, I was reading your column over today and what you had written last week kind of as a preview into this event. And I thought you made a good point about kind of the airification that we've seen in the past, of course, with the MacBook and other things, and the idea that, yeah, this is going to be a much thinner iPhone, but obviously you're sacrificing some degree of performance and battery life at a time where, I mean, the iPhone's pretty slim and light. I have the 16. I mean, how much thinner does it need to be? And I do wonder, is there the potential that this might actually work against Apple, that if you're offering something with potentially less battery life than the alternative, that in and of itself might not make it worth it?
Yeah, I think people aren't going to buy this phone. I think that I'm not going to go as far as saying it's going to be a dud, but Samsung came out with a very similar concept in May that's called their S25 Edge. Same exact thing, lesser cameras, lesser performance, lesser battery life, super thin. People just don't want that. I'm sure Apple has marketing that tells them that maybe there is demand for this type of phone, but something that's thinner and lighter but has sacrifices on the things that most phone owners and upgraders care about, that is not a healthy combination. But this is a long-term play. The MacBook Air that came out from Steve Jobs in 2008 was amazing for how thin and light it was. Same thing, this iPhone 17 Air is going to be amazing for how thin and light it was. But the real story was the 2nd generation MacBook Air that came out at the end of 2010. That changed the whole course of MacBook history and the whole PC market. That's because they were able to combine that thin and light of the original 2008 MacBook Air, but get it to the point where you had good battery life, good performance, and better pricing. And so when Apple's able to get an iPhone 17 Air design with pro performance, pro cameras, pro battery life, and good pricing, they'll be in really, really nice shape.
Mark Gurman, who covers all things Apple for us, getting ready for, of course, that big product announcement tomorrow afternoon, East Coast time. We'll have full coverage of that right here on Bloomberg. I want to bring Tony Wang into the conversation. He's portfolio manager of the Science and Technology Fund over at T. Rowe Price. And Tony, I want to pick up where Mark actually left off here. The idea that maybe this iteration of the iPhone Air might not necessarily be a smash hit, but at least in his view, he says that what we saw with the MacBook Air some years back did really lay the foundation for what I think now, at least for a lot of folks, including myself being a MacBook Air owner, is kind of the flagship for a lot of folks when it comes to Apple computing.
Yeah, well, I think that form factor is a big reason why people get the new iPhone. And so I think the market is going to be excited about something that's new, that's different. And I think that performance is probably what the market will also look at in terms of the camera, the battery. But, you know, I think it could be a step to another kind of generation of form factor. In addition, I think it could set up and be a good precursor to perhaps foldable. So I think that the install base is due for an upgrade. A lot of those phones that were kind of bought during COVID are coming up for renewal. So to me, I think it's an exciting event, you know, to start.
Foldable, yeah. I think it was maybe a few, I think the last big event that we had Steve Wozniak on. He was saying, where's my foldable phone? So maybe we'll get it, Tony. I do want to ask, I know this is a hardware event, but there's going to be a lot of focus one way or the other, whether they like it or not, on the actual software itself, and more importantly, things like Siri, the AI strategy. And I am curious as to whether you think they will at least maybe potentially give a nod to what that strategy might be, even in the absence of a full-on announcement.
Yeah, well, I think those two can go hand in hand. I think as you have more advanced software and a more advanced Siri, you can call for better processing chips, you know, perhaps a better camera as well. So I think that there will be hints, and there have been, you know, speculation that could they have a deeper partnership with Gemini or ChatGPT. And I think that, you know, at the end of the day, Apple owns the ecosystem, the distribution, and so their skill is really integrating both the hardware and the software together.
Tony, I want to talk about how you're approaching this as an investor. As we mentioned, you're a portfolio manager of the T. Rowe Price Science and Technology Fund. I see, according to Bloomberg data, that Apple is the 5th biggest holding in that fund. So when it comes to tomorrow, I mean, how closely are you following these updates on the hardware versus the issue that's been haunting Apple, which is the idea that they're behind when it comes to AI?
Yeah, I think that what's really important is that, you know, Apple users continue to be in the Apple ecosystem. People aren't switching out onto Samsung or any other platform. And, you know, to me, it's been a long time since Apple's actually raised prices on their smartphones. And the last big form factor was really, I think, the X. And so to me, there could be latent pricing pressure on top of an install base that's really primed for a new phone. So, you know, I think the Air will probably be a little bit more incremental, but I think eventually foldable in 26 or 27, the market has already showed that the market wants something like that. You see a lot of the phones in Asia be really successful.
Well, that word incremental, using that to describe Apple's event tomorrow, it feels like we could apply that word to some of their other events and announcements that we've seen over the past year. Apple shares down about 5% year to date. As an investor, are you frustrated with these incremental updates, or has Apple's performance over the past decade more than made up for that?
Well, I think what's great about Apple is that they've built you know, a lot of trust among their ecosystem partners. The consumers really love the brand, and what they're really good is not necessarily being first to market, but integrating technology really seamlessly into people's lives. And so, to me, I think that yes, there's a lot of kind of negative press around Apple being behind, but I think they've taken a different strategy of you know, creating tools and integrating the latest technologies into those tools. So to me, I don't think it's too late. And if anything, like, you know, the narrative can really change because they do own the distribution, I think, of AI. You think about how people are consuming AI is largely through their phones.
And I do want to go back to the hardware side here for the last question, Tony. And I'm curious about pricing power. I mean, there was a lot of talk earlier this year about what the price of a new iPhone would look like in the face of tariffs and just overall concerns about economic conditions. And I am curious as to whether, A, you think they will be able to nudge things a little bit higher, not only on this release, but as we sort of look ahead to maybe potentially a new iteration of this device over the next year or two. Do you think we will see that price materially higher in Apple's favor?
Yeah, I don't think they're going to be raising prices on like-for-like product. But when you think about it, the iPhone is pretty much the most important thing in your life often. Like, it's your remote control to your life. And to me, there's a lot of latent pricing that they can take by offering more value, better technology. Full of a phone, could it be $2,000? Like, to me, like, if it's really compelling, I think that's like really, I would buy that. And when you think about how a lot of these phones are paid off, it's over monthly installments. And we're talking like $15, $20, $25 a month, which in the grand scheme of things, being such a utility, to me, I think there's reasonable pricing that could surprise the upside on top of units from an install-based upgrade.
All right, Tony, great to get some time with you ahead of the big day. That is Tony Wang. He is portfolio manager of the Science and Technology Fund over at T. Rowe Price. Romaine, talk to me.
Well, just speaking, of course, of telecommunications, Katie, we had that big sell-off earlier today in AT&T, still down in the after-hours trade. They got a big presentation at a Goldman Sachs conference and just coming out now and saying that they are going to reiterate their full-year guidance for the year, saying they're still on track to achieve that.
Yeah, interesting to see them come out with that after, like you said, of course, we got that big news with EchoStar and Starlink and SpaceX. AT&T reiterating their full-year guidance.
Now, do you put your iPhone first ahead of your husband and your family?
It's hard to say. So, I'm going to have to really
you don't want to say that
meditate on that during the commercial break. But
I do.
Yeah, you do?
It's phone, family, God, country.
What if it was a thin iPhone? It's hard to weigh out those different options there. But coming up, we're counting down to tomorrow's BLS revisions to last Friday's market-rattling jobs report. Will September's Fed cut stay in play, or could a substantial swing change the outlook? We'll break it down with Bloomberg's chief U.S. economist Anna Wang next. Well, tomorrow's data from the Bureau of Labor Statistics is critical for the market as investors seek clarity on how the U.S. economy is faring. Economists expecting another sharp downward revision to March's numbers, with the last decade featuring larger and larger swings. Let's discuss with Anna Wang. She is chief U.S. economist over at Bloomberg Economics. So, Anna, just quickly set the scene for us. What data are we getting tomorrow? Because this is one of the reports that typically we don't pay that much attention to relative to the monthly jobs figures.
So tomorrow's report will flag what the benchmark revision will look like that will finally be released early next year. It described the downward revision from April of 2024 to March 2025. And the market is expecting, the consensus is a negative 700,000 downward revision over this 12-month period.
So what does that actually mean, though? Because when we talk about this idea, all the controversy over these revisions, at least the controversy stirred up by the administration, as an economic read, what does this tell us? Does it mean that policy decisions made 12 months ago were wrong?
Well, actually, it would suggest the opposite. It would say that the jumbo rate cut in September last year was right, because these revisions suggest that each month of most of last year would be downwardly revised by, 45,000 to 60,000 each month, which means that throughout the summer of 2024, hiring was actually very weak, well below stall speed. So Powell was completely correct to cut by 50 bips.
Just really quickly here, Anna, does this report, or this revision, will that have an impact on the discussion at the Fed next week during their meeting?
I think that the result would be surprisingly small. We are actually expecting 560 downward revision, and I think it wouldn't be a factor going into next week's FOMC.
Anna Wang, chief U.S. economist over at Bloomberg Economics. And Katie, we're expecting that report, those revisions, I should say, at 10 a.m. Washington time tomorrow.
Yeah, and that is the big question. What does it mean for the Fed? These are more accurate figures, but kind of stale at this point.
Yeah, more importantly, what's the reaction going to be from the political horde in Washington? Well, you can hear all about that. Stick around. Joe Matthew on Balance of Power is up next.